Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way.
Sounds good to me. I mean, there is certainly a lot to break down today.
There really is. The mission for today's deep dive is basically figuring out how you are supposed to pick long-term investments right now. Because navigating the current U.S. economy under President Trump is, well, it's sending us some extremely mixed signals.
Oh, absolutely. The cross currents in May 2026 are just wild. According to recent analysis, we're living in this totally complex environment where both high-risk assets and super safe defensive assets are surging at the exact same time.
Right, and that is not supposed to happen.
No, it's really not. I mean, we just look at the raw numbers from the data. The S&P 500 and the NASDAQ just hit all-time highs in early May.
Yeah, driven mostly by all this massive AI optimism, right? Like companies like AMD giving these really positive outlooks.
Exactly. I mean, RBC even raised their year-end target for the S&P 500 up to 7,900 on May 8th. So Wall Street is feeling incredibly confident.
But then, and here's where it gets weird. You look at gold. Gold is also sitting at near record highs.
Yeah, closing at, what, $4,720.40 an ounce on May 8th.
Yep. And it actually crossed 5,100 back in January. So investors are buying up gold like it's the end of the world, while simultaneously throwing this massive AI party in the stock market.
It's a total paradox. And meanwhile, if you step away from Wall Street, everyday people are really feeling the pinch.
Oh, totally. Main Street's getting squeezed hard. U.S. consumer sentiment just plummeted to a record low of 48.2 in early May.
Wow. Yeah, and a big part of that is just the pain at the gas pump, right?
Exactly. The March CPI data showed inflation sitting at 3.3% year over year, but energy was up 12.5%.
That is just brutal for the average person. So you have a suffocating consumer, a skyrocketing tech market, and gold behaving like we're in a global crisis.
Right, which leads to this huge aha moment for anyone trying to invest right now. Because of this bizarre environment, the old rules are just broken.
Oh, completely broken. You can't just pick a stock because it, went up a lot recently.
Exactly. And that leads us perfectly into how we actually measure success when the rules of the game have completely changed on us. Which brings us to the end of free money.
Ah, yes. The return of cash. This is probably the most fundamental shift in the 2026 market compared to the wild days of, say, 2020 or 2021.
Now, because back then, cash literally paid you 0%.
Yeah, holding cash was basically a guaranteed way to lose purchasing power. But today, the Federal Reserve maintained its benchmark interest rate at 3.50 to 3.75% on April 29th.
Okay, so what does that actually mean for the average investor?
Well, it means the 3-month U.S. Treasury yield is sitting at a solid 3.61% right now, as of May 7th.
Okay, let me put this in everyday terms. It's basically the difference between sitting on your couch for free versus someone coming up to you and saying, hey, I'll pay you $20 an hour just to sit on that couch safely.
I love that analogy. Yes, exactly.
Right. Like, if you're getting paid $20 an hour to do absolutely nothing safely inside your house, why on earth would you go outside and hustle in the blazing sun for just $21 an hour?
You wouldn't. The effort and the risk just aren't worth the tiny bit of extra money.
So doesn't this mean every single investment we look at today has to be judged against that 3.6% couch money?
Yes. That is the new golden rule. According to the research, we just can't look at total return in isolation anymore. We have to look at excess return compared to cash.
Excess return. Okay, break that down for me.
Sure. So it fundamentally changes how we view an asset that yields, say, 5 or 6%.
Because 6% sounds pretty good to most people, right?
Yeah, it does. If someone says they're making 6%, your 2020 brain thinks, wow, great job. But in 2026, you have to subtract the 3.6% you could have made just sitting on the couch in government bonds.
Oh, wow. So your actual reward, the excess return for taking on all that risk, is only like 2.4%?
Exactly. You are taking on all the stress of the stock market or corporate bonds for just an extra 2.5%.
That really puts things in perspective. So if a 6% return isn't actually that impressive anymore, it means we need to look a lot closer at how an investment achieved its numbers.
Which brings us to the danger of raw percentages. Looking at cumulative returns can be incredibly deceptive.
Yeah, like when someone says, oh, this stock went up 1,000% over 20 years.
Right. Recent analysis shows that metric is just too rough for making actual smart investment decisions. It hides the entire journey.
So what's the better metric then?
Institutions rely heavily on CAGR. That stands for compound annual growth rate. It mathematically smooths out the historical performance.
So it shows you what the steady year-over-year growth actually felt like.
Exactly. It gives you the true compounding rate.
You know, it's kind of like driving cross-country. Imagine you have two drivers, driver A and driver B.
Okay, I'm following.
They both average 50 miles per hour over the whole trip from New York to LA. But driver A went a steady, relaxing 50 miles per hour the entire time. Listened to podcasts, enjoyed the view.
Sounds like a nice trip.
Right. But driver B's car broke down in the desert for 3 days. They totally panicked. And then they had to drive 120 miles per hour through a storm just to catch up and arrive at the same time.
Oh, man. Yeah, they have the exact same final result, but driver B's trip was absolutely terrifying.
And dangerous. I mean, I wouldn't want to be in the passenger seat for driver B.
And you shouldn't want that for your money either.
Yeah.
This applies so perfectly to the 2026 market, specifically with the whole AI, semiconductor, and big tech boom.
How so?
Well, a lot of assets look incredible right now. Their long-term averages look great, but it's only because of a massive, frantic 1 to 2 year spike. It's driver B hitting 120 miles per hour.
So they were basically flat or broken down and then just rocketed up recently.
Yes. So investors really need to ask themselves if this growth is coming from long-term compounding cash flow improvements or if it's just a short-term theme concentration.
Like, are we just buying into the hype?
Right. Because if it's just hype, the moment the narrative cools off, that speed drops back down to zero.
That makes a lot of sense.
Yeah.
But, you know, driver B's journey was incredibly bumpy. And in finance, we generally call those bumps volatility.
We do.
But is all volatility actually bad? Because traditional metrics punish volatility, right?
They do, mainly through standard deviation. Based on recent analysis, standard deviation just shows how much an asset's price bounces away from its average.
But wait, let me push back on that for a second.
Go for it.
If I buy a tech stock and it steadily rockets straight up day after day, its standard deviation is technically going to be very high, right? Because it's moving far away from its old average.
Mathematically, yes, it would be high.
But that's good volatility. I'm making money. So standard deviation alone seems kind of flawed. It treats my stock rocketing to the moon as the same amount of risk as my stock crashing into the ground.
And you've hit the nail on the head. It's a huge flaw. Standard deviation measures dispersion, but it doesn't measure destruction.
Okay, so if standard deviation is flawed, what actually matters to a normal human investor?
What actually matters is maximum drawdown, or MDD, and recovery time. This is the true psychological and mathematical test of an asset.
Maximum drawdown, so the biggest drop from top to bottom.
Exactly. The largest single percentage drop before a new peak is achieved.
It's like the biggest, scariest drop on a roller coaster.
That's a great way to picture it.
Like if a coaster has a 500-foot vertical drop, it really doesn't matter how smooth the rest of the ride is. A lot of people are going to throw up and demand to get off immediately.
Yeah. Human psychology just can't handle it. In investing, if an asset drops 50%, most normal people just panic and sell.
Which means they lock in their losses and never even see the eventual recovery.
Right. And mathematically, a 50% drop is devastating.
Oh, because of the hole it digs, right? Like if I have 100 grand and it drops 50%, I'm down to 50 grand.
Yep. And how much do you need to make to get back to 100 grand?
Well, most people think you just need a 50% gain to get back. But a 50% gain on 50 grand only gets me to 75 grand. I'm still underwater.
Exactly. To get out of a 50% hole, you actually need a 100% gain just to break even.
Wow. You literally have to double your money just to get back to where you started. That is exhausting.
It destroys your compounding. Let's connect this to real-world 2026 examples. AI stocks might have huge growth potential, but they also have massive MDD if earnings miss expectations even slightly.
Right, they could drop 40% in a heartbeat.
Easily. And people think long-term bonds are totally safe, but if interest rates rise because inflation stays sticky, bonds can suffer really big price drops too.
And don't even get me started on crypto or thematic ETFs.
Oh, those routinely see 50 to 70% maximum drawdowns.
No.
So as an investor, you have to look in the mirror and ask, can I actually stomach a 40% drop without panic selling?
Honestly.
Most people can't.
No, they really can't.
Okay, so we know we need returns that beat that 3.6% cash rate. And we know we need price drops small enough that we don't throw up on the roller coaster.
Right.
Is there like a magic formula that combines both of these things?
There actually is. It's called the Sharpe ratio. It's the ultimate stress test for an asset. The Sharpe ratio. Okay, how does that work in our 2026 reality?
It basically formalizes what we've been talking about. You take your asset's overall return, You subtract the 3.6% risk-free rate, the couch money, and then you divide that remaining number by the asset's volatility.
Okay, let me make sure I'm following the math. Let's make it real.
Let's do it.
Say an ETF gives you a 6% return,
Mm-hmm.
and it has 15% volatility. 6% sounds okay on paper,
It does.
but we subtract the 3.61% Treasury yield. So our excess return, our actual reward, is only 2.4%.
Right.
And then we have to divide that tiny 2.4% by a massive 15% headache. It really shows you that you're taking on a ton of risk for almost no reward over safe government bonds. You really have to ask, is the juice worth the squeeze?
Exactly. The Sharpe ratio tells you if the juice is worth the squeeze. And to make sure you aren't being tricked by the data, you also have to use rolling returns.
Rolling returns. How is that different from just looking at what a stock did last year?
Well, looking at standard calendar years like January to December is highly deceptive.
Why is that?
Because of how Wall Street works, a stock could drop 30% all year long, causing investors absolute misery. But then, on December 31st, a bunch of funds buy in to dress up their portfolios, and the stock rallies to close the year up 2%.
So the brochure says positive year, but anyone who actually held it all year is completely traumatized.
Exactly. It hides the pain. Rolling returns, on the other hand, look at every possible 3-year, 5-year, or 10-year window.
Oh, I see. So it doesn't matter if you start counting in January or March or October?
Right. It evaluates every continuous period. It shows if the investment still made money, even if you had the terrible luck of buying at the absolute worst possible time right before a crash.
It's basically a test of whether the asset has a real internal engine rather than just relying on lucky market timing.
Precisely.
But wait a minute. All of these metrics we just talked about, KGR, maximum drawdown, the Sharpe ratio, rolling returns, they're all looking in the rearview mirror.
They are entirely retroactive, yes.
Right. And past performance doesn't pay for tomorrow's groceries. A company could have great rolling returns for the last 10 years, but if their industry gets disrupted by AI next week, those old numbers are useless. How do we know an asset will actually survive the future?
That is the big question. And based on the data, I have to issue a strong warning here. Great historical numbers are merely the results of past economic structures.
Okay, so numbers are just part of the story. What's the rest of it?
To survive long-term, an asset must have structural growth for the future. You have to separate the hype, the narrative, from the hard structural numbers.
Let's break that down by asset classes. What are the true indicators of future survival if I'm looking at, say, individual companies?
For companies, you want to see real revenue growth, strong free cash flow, high return on equity, and crucially in 2026, manageable debt. Debt is expensive right now.
Right, because of those 3.5% interest rates. What about dividend stocks? People love seeing a high yield.
Dividends can be a massive trap today. You can't just look at a high yield and buy it.
Why not?
Because you have to look at the payout ratio. Are their profits actually covering the dividend? If a company's debt costs are rising, they might be borrowing money just to pay you that dividend.
And that's not sustainable.
Not at all. A high dividend might just be a mirage before a massive cut.
Oh, wow. Okay, what about ETFs? A lot of people just buy the index and go to sleep.
You have to ask yourself if the underlying index actually captures future core economic growth. If an ETF is just heavily weighted in a few hyped-up tech stocks, you're taking on massive concentration risk.
Which brings us back to gold. It's at near record highs. But what's its structural growth?
It doesn't have any. Gold hedges against geopolitical and currency risks, absolutely.
Yeah.
But it produces zero cash flow. It doesn't compound.
It just sits there.
It just sits there. So the core 2026 challenge is this. AI is a massive opportunity, yes, but paying prices that reflect completely perfect future expectations is incredibly dangerous.
Because no one is perfect, and reality usually has a few bumps in the road.
Exactly. Survivability is about hard numbers, not just a great story.
I think we really need to summarize this entire journey, because we've covered a lot of ground.
We really have.
So if you're listening to this in May 2026, picking a long-term investment is not about finding what went up the most recently.
Definitely not.
It's about finding an asset that repeatedly generates excess returns over that 3.6% cash yield. It has to survive multiple cycles without dropping so far that it scares you into selling, and it has to maintain real structural growth for the future.
That is the exact formula for navigating this environment. But, I want to leave you with one final, slightly provocative thought to ponder.
Oh, I love these. Lay it on us.
We didn't talk about this directly, but think about it. If everyone in the market, all the smartest algorithms and institutions are looking at the exact same AI narratives and the exact same 3.6% Treasury yields.
Yeah.
Where is the quiet, boring corner of the market right now that everyone is totally ignoring? Because that boring corner might quietly be building the absolute best rolling returns for the year 2036.
Oh, I love that. The boring corner is usually where the real wealth is built while everyone else is distracted by the shiny new toy.
Exactly.
Well, that's a perfect thought to end on. Thank you all for joining us on this deep dive. Don't forget to subscribe and hit that like button.